how much money can I save tax-free? That's the question coming in today. The problem is there's no such thing as tax-free. But what I'm going to talk to you about is different ways, and I'm going to help you reframe that question. I think it'll provide some clarity on how you should be saving. Why do I say there's no such thing as tax-free? You hear about tax-free all the time, tax-free retirement income, all this sort of stuff. You hear it on our channel, but I'm here to tell you there's no tax-free. You're gonna do one of two things. You're gonna pay the tax today and invest it, hopefully, into a vehicle that you do not pay taxes on in the future, or you're going to defer your tax, invest it in a vehicle, and pay taxes on the distributions of that later at an unforeseen date and time, right? The problem with the latter is that I don't know what the tax rate's gonna be. And what we've been told is, oh, when I'm in retirement, my tax rate's going to be less, but is that really true, right? If we think about the amount of spending that's happening today from the government, well, are they going to charge us more in taxes later or less in taxes? And that's one of the things you really have to think about when you're deciding what to do here. But let's talk about tax-free retirement vehicles and what those look like. So let's pretend that today you pay the tax on all the money that comes into your world, and you have the option to invest in a Roth IRA, right? A Roth IRA will grow tax-free and be distributed income tax-free as long as we wait until 59 and a half, right? So that's the rules they put on there. And you can save up to $6,000 a year in that plan. But if you're over 50, you can actually add another $1,000 into that. What happens though is every couple years or every so often that number is going to increase. These are government rules, so those are changing all the time. So just check the numbers when you're looking at this video to make sure the numbers I'm giving you are accurate to when you're watching this, right? But let's stay on that, right? 6,000, 7,000, but there's another rule they tie to that. So it's not just how much you can contribute, but it's also how much money are you making. If you're making a certain amount of income, you're not going to be able to contribute to this plan.
Hey, this is Rob Gill for the Money Minute, and Eddie Gartner is dropping some world-class knowledge that could help put money back into your pocket where it belongs. Go ahead and hit that subscribe button so you can hear more videos from Ed.
So if you're a married couple making over $198,000 combined, or a single person making over $125,000 combined, and remember, those numbers are always changing, but right now those are the limits. Once you start getting over that, you're no longer going to be able to contribute that $6,000 or $7,000 depending on your age. And so what happens is then you get up to, as a single filer, over $140,000, and as a married couple over $208,000, and you can't put in anymore. So it's zero, right? So what happens to a lot of people is they'll start out young and they'll start contributing to a Roth IRA because this is a great savings vehicle and a great vehicle for tax-free income, in the future. Because why? Because we paid the tax today, and all of the growth in that vehicle, it can grow, it's invested in the market, whatever it's doing. When I start taking the money out, I'm not gonna pay taxes on it, assuming I wait till 59 and a half, the way that it's designed to be. However, because taxes are always changing, there's actually a loophole. If you wanted to do a Roth conversion, you could still contribute money to your Roth IRA even if you're earning over $200,000 as a married couple. And how do you do this? You do something called making a non-deductible contribution to a traditional IRA. I know it sounds like a lot. You may want to work with your accountant or your financial advisor on this, but one of the things that you can look at doing is making that contribution to this IRA, but not deducting it from your taxes, right? So this is something you're going to talk with your accountant about. And by doing that, you can then do a conversion on that traditional account to put it back into your Roth. It's a little loophole that still exists. For how long it exists, we don't know, right? Because it's in the tax law, it's subject to change. If that's something you're interested, click the link below for a free game plan. What else can I do, right? The most I'm able to do is $7,000 if I'm over 50, and that's not going to get me to the savings goal that I want or get me to the retirement that I want, but I still want tax-free income. How else could I do it? If your employer is generous enough to provide you with a 401k and that 401k has a Roth option, that will allow you to put in even more money, right, into that Roth style bucket. Again, we're not taking any tax deferral. We're paying the tax today on that money, putting it in that Roth bucket, that Roth 401k or that Roth IRA, and we're going to allow that to grow, as we continue on. But for other people, one of the things that they're using and one of the things that they're looking at, because there are no limitations on our income, right? It's not that I make too much and now I can't do it anymore. One of the vehicles they'll use is life insurance. But we're not talking term life insurance. We're not talking like regular universal life insurance for death benefit. What we're talking about is a permanent cash value style life insurance policy. People will use these policies to grow their money in a tax deferred manner, right? So they're putting the money in. They've already paid the taxes. They're going to put it in there. They're going to pay no taxes on the growth like they would in a regular bank account. So when we go to take the money out, let's say it's in retirement time, we can do something called surrendering the paid up additions that have grown inside of that policy. We can surrender those and take those by giving up death benefit. And then when we've surrendered all the paid up ads, then we can take a loan from the policy and use that to supplement our income tax-free in retirement as well. So it's another vehicle that people use, especially when you get into the higher income areas where you want to be able to save more, and the limitations to a Roth account are just too great. That was a lot of content to go through. I hope this is really helping your education on tax-free versus taxable and how you can save in the most efficient manner. Now, if you've been saving in a standard traditional IRA or 401k, we actually did a video that talks about how those distributions are taxed, and that's right over here, or here, I'm not sure.